Welcome back to Portfolio, everyone. And today we have a big stock battle between Home Depot and Lowe's. We're going to break down the company fundamentals, go through some different metrics, and compare which company may be the better buy right now. We're going to go through the important financial metrics you look at when evaluating different stocks, and of course do a comparison between the two to determine which company is superior and which one is the better buy. So both of these companies operate within the same sector of the market and essentially do the same thing. They are retailers that provide hardware products and many other home improvement products to consumers. So of course people are extremely familiar with both of these brands. Lowe's is a dividend king and Home Depot has been an established part of people's lives for many years. So these are long, very nice, well-established companies that have long histories of growing revenue and income for years and years, and both of these companies I believe will continue to grow long into the future. I don't believe they have any big competition that will knock them out of the market, and I do believe these two companies form a duopoly at the top of the hardware service market. So we're going to do a big comparison of them today, break down some key metrics, and determine which company beats the other. But before we do that, I am the Gen Z investor, everyone, and as you know, I post videos on this channel every single day about the stock market, different stocks you can buy, and overall stock market performance. So if you're interested in the stock market, please like and subscribe, and you will see my daily videos. So we're going to jump right into this big comparison. So we have a couple different metrics we're going to compare between these two companies. Some are more important than others in my opinion, but overall they give you a nice overall perspective about which company beats others in different factors. So first thing we're going to take a look at here is market cap. So this is the least important least important metric I'm going to say during this comparison. So market cap of course just shows how large the company is, but does that really mean one company is more superior to the other? Does the bigger company mean it's better than the other? Not really. We have to look at other financial metrics to determine which one may be a better buy, but I did want to include it here, and as you can see, with a market cap of $285 billion compared to Lowe's $112 billion, Home Depot is the larger company. Before we break down some more key financial metrics, let's just take a look at how the price chart of each of these companies has performed over the past couple of years. So if we take a look at Home Depot, ticker symbol HD, currently at $263 per share. On the 1-year chart, they're up around 25.5%. So you can see here they saw the March lows, but have recovered and have reached highs above their pre-pandemic level. And on the 52-week range, they are trading very close to an all-time high right now. If we jump over to Lowe's chart, you can see here on the 1-year chart, they're up around 45%. Again, saw the March lows, but have greatly surpassed their pre-pandemic levels and are once again at an all-time 52-week high. So Lowe's has actually performed better on the 1-year chart. If we move over to 5 years, Lowe's has a share price appreciation around 120%, so a beautiful upward trend over the past 5 years. If we jump over to Home Depot, you can see they have a price appreciation around 130% over the past 5 years. So both of these companies have very similar price charts. Home Depot went up over 5 years 130%, and Lowe's went up 120% on the 5-year chart. If we jump over to look at total returns over the past 5 years, so the first one we're going to take a look at is Home Depot. 5-year total return for Home Depot was 152.9%. If we jump over to Lowe's, you can see here the 5-year total return was around 131%. So Home Depot has outperformed Lowe's over the past 5 years by about 20% total over those 5 years. That includes dividends reinvested. If we take a look at the overall market returned around 70% over the last 5 years. So both Lowe's and Home Depot actually more than doubled the market return. Home Depot provided around 153%, which of course more than doubled the 5-year total market performance, compared to Lowe's, who almost came close to doubling at 131%. So Home Depot has slightly outpaced Lowe's over the past 5 years. Both companies have performed amazing and have actually outperformed the overall market by a huge gap. So if you were to hold both of these companies over the past 5 years, you would have been very happy and you would have seen exponential growth that actually beat the overall market. If we take a look at these companies and move on to some of the first thing we're going to take a look at is the revenue. So Home Depot is the larger company, and they actually do win on the revenue battle. They brought in $112 billion of revenue last year. So all these numbers you can take a look at right here are from their last report and of the last 12 months. So Home Depot brought in $112 billion worth of revenue. Meanwhile, of that revenue, Home Depot, of course, brought in $11 billion, while Lowe's brought in $4.6 billion in profit. So if you see, Home Depot brought in more revenue, so they did bring in more profit as well. So they do win both of those battles. But of course, an important thing to take a look at is, for every dollar revenue, what percentage of that is net income? So that's, of course, the profit margin. So if we take a look at the next metric here, Home Depot actually does have a higher profit margin, where around 9.82%. Meanwhile, Lowe's profit margin is only around 6.22%. So although Home Depot is the larger company and they did bring in more revenue and profit, one metric that might have made you pick Lowe's over Home Depot with regard to revenue is if they had a higher profit margin. But they actually don't, and Home Depot wins that battle again. So as of right now, Home Depot is showing to be the stronger company and may be the better buy with regard to how their income statement performs. The next important metric we're going to take a look at is their PE ratio. So this is a forward PE. So this, of course, PE ratio is how much investors are willing to spend per dollar of company earnings. So lower PE ratio essentially means the stock is somewhat cheaper compared to others. So these two companies who operate within the same sort of market basically do the same thing. The lower PE ratio actually wins here because that just shows Lowe's at a PE ratio of 21.92. You can buy $1 of the company's earnings for less money than Home Depot if you want to pay around 26.25 per each dollar of company earnings. So Lowe's gets on the board for their first win of this battle, and they actually win the PE ratio battle where their forward PE is around 21.92, beating out Home Depot's forward PE at 26.25. So right now, Home Depot is winning this battle right now, but there's a couple other key metrics we got to take a look at when evaluating these two companies. So we're going to continue on down this chart. The next thing we're going to take a look at is the dividend. So this is a very important thing to take a look at because as dividend growth investors, we like companies who continue to grow their dividend year over year. So both of these companies spot somewhat low yields. They're not yielding 4+%. Home Depot, you can see here, is yielding 2.26%. Meanwhile, Lowe's is yielding around 1.48%. So that means Home Depot, of course, wins this battle because they do have the higher current dividend yield. But if we look at dividend history, Home Depot's dividend history is around 10-11 years of dividend growth. Meanwhile, Lowe's is a dividend king. So they've been growing that dividend for over 50 consecutive years without cutting it, without missing a payment, without reducing anything. They've grown their dividend for over 50 straight years. So if you were to look at dividend history, Lowe's wins that battle. I didn't include that right now, only because both of these companies have surpassed a 10-year dividend growth streak. So they both have a decent history in growing that dividend. So I didn't believe the fact that Lowe's is dividend king versus Home Depot really affected if it was a good buy right now. I believe we have to look into the future, and that is really a past measure. So the next thing, of course, with the dividend is, of course, we like seeing the dividend yield, but how fast are they growing that dividend? It's nice if one company pays a higher yield right now, but if their competition is growing their dividend at a much higher rate, then I would really choose the competition. If we take a look at the 5-year dividend growth rate for each of these companies, they both have incredible 5-year dividend growth rates. They are both growing that dividend at a very, very fast rate, outpacing inflation by a mile. So you see here, Home Depot's 5-year dividend growth rate is around 23.68%, and Lowe's is at 20.23%. So of course, Home Depot once again wins this battle, but this is nothing to be ashamed of. Although both of these companies have somewhat starting lower yields, they are both growing their dividend at an insane rate at over 20% average over the past 5 years, which is absolutely remarkable. Now with that dividend, you want to see how safe that dividend is. It's very nice to buy a company with a nice yield, but if their dividend is at risk of being cut, then it's pointless because there's a big risk that that company may cut the dividend, and then of course, the stock price usually falls when companies cut their dividend, and then you might lose your total returns over the long run. But with dividend safety, both of these companies have a very safe dividend. So I get this dividend safety score from Simply Safe Dividends, and any dividend score of 81 and higher is ranked as very safe. So you see here, Home Depot's dividend safety score is 87, and Lowe's is 93. So Lowe's does win this battle with regard to dividend safety. But once again, they both considered very safe. So there's very unlikely that Home Depot will cut their dividend anytime soon. And with regard to dividend, you want to see how much of the company is actually paying out as a dividend. So there's two different payout ratios we're going to take a look at with regard to how companies pay out dividends. First one is the most popular one, which is earnings per share payout ratio. So Lowe's wins this battle as they have an earnings per share payout ratio of 36%. Meanwhile, Home Depot is paying out around 60% of its earnings as a dividend. So for every $1 of company's net income, Home Depot pays around 60% of that as a dividend. Meanwhile, Lowe's only pays out 36% of that as dividends. The next important metric is free cash flow payout ratio. So of course, companies generate free cash flow, and that's the actual money they use to pay out the dividend. So how much percent of their free cash flow is going out as a dividend? Home Depot's is around 54%. Meanwhile, Lowe's is at a better 34%. So once again, Lowe's is paying out less money per share of free cash flow compared to Home Depot on a percent basis. So even though Home Depot has a higher yield and higher dividend growth rate, they are paying out more of their earnings and more of their free cash flow out as a dividend. So there's less money staying within the business in order to grow. So of course, people have to keep that in mind and keep really determine if that really affects them. So of course, a 60% earnings per share payout ratio for Home Depot is extremely sustainable. There's a lot of money still staying within the business in order to grow operations, and there's still enough money left over to grow the dividend in the upcoming years. So of course, they are getting beat by Lowe's, which has lower ratios in both sides, but it's also nothing too worrying with Home Depot at that 60% rate right now. Another key important metric is we have to take a look at the balance sheet. One of the important metrics from the balance sheet is the current ratio, which is total current assets divided by total current liabilities. And what you want is you want a current ratio at least above 1. A sweet spot is to have for companies that have current ratios at least 1.5 and higher. So neither of these companies have a current ratio around 1.5, but Home Depot's current ratio is at 1.17 and Lowe's is at 1.12. So once again, slight win for Lowe's here with their current ratio just above Home Depot's. But overall, both these companies have decent current ratios. Both of them should try to improve it over the next 12 to 24 months, try to bump up that current ratio as much as possible. And with regard to that current ratio, considering both of them have that ratio over 1, means they have enough total current assets on hand to deal with all of their short-term liabilities within the next 12 months and continue to grow the business. So nothing too worrying from each of these companies. But now that we've done our comparison, you can see here, what we talked about at the very beginning was that Home Depot had a total return over the past 5 years at around 152%. Lowe's total return over the same 5 years was around 131%. So over the past 5 years, Home Depot has slightly outperformed Lowe's by around 20% total over a 5-year span. But if we take a look at this battle we have for current share price and current financials, Home Depot won 1, 2, 3, 4, 5, 6 battles. Lowe's won 1, 2, 3, 4, 5 battles. So 6-5, Home Depot technically won this battle. But of course, if we were to take out the first ratio, which is market cap, it would actually be a 5-5 tie. So of course, a lot of people value market cap, and I've heard a lot of comments when discussing stock battles to include it, so that's why I did, and I will continue to do so because it is still nice to see which company is larger than the other, and it really puts things in perspective. If I didn't include market cap in this comparison, and you saw Home Depot did $112 billion in revenue versus Lowe's $74, you would think, oh wow, Home Depot is killing Lowe's. But if you put it relative to the market cap, Lowe's actually earns more revenue per their market cap compared to Home Depot. So you have to have that perspective in mind and look at the size of the companies when evaluating if their revenue is good compared to the other. So as my comparison between Home Depot and Lowe's, if I were to own these companies, I would actually hold both in my portfolio. That's actually what I do own. I do personally own Home Depot and Lowe's. I do not believe I want to pick one or the other. I do like both companies. I believe the actual industry that they operate in will be here to last. I don't believe there's going to be any big competition that's going to, take out the lumber market and the need for contractors to go pick up tools and, different nitty-bitty nails, screws, whatever it may be. I still believe the need to go in person to order these products is still going to be there. So I do believe Home Depot and Lowe's will continue to operate very nicely into the future. So I personally hold both within my dividend growth portfolio. Lowe's, of course, is that dividend king, and I love that strong dividend history. And Home Depot, I love the business model. I love both of these companies. So if you have to determine which one is right for you, if you only want to hold one, if you can hold both in your portfolio, I don't see why not. Both of them have outperformed the market, and of course, they both did extremely well over the past 5 years. And as long as this industry doesn't change completely, both of them should continue to see nice growth long into the future. They pulled nice, sustainable, growing dividends. And of course, there's nothing more you can ask for from a dividend growth company. And that was my comparison. I hope you enjoyed the stock battle. Like I said, I make videos every single day on the stock market. So stay tuned for tomorrow's video, and I will see you then. Bye.